I need to tell you something that could change everything about how you invest over the next few years. Something that most people are not even thinking about because they have gotten so used to the current environment. Interest rates could crash in 2026. And if they do, there is only one investment I would make with every dollar I have. Now, when I say crash, I do not mean a small decline. I mean a dramatic move lower, the kind of move that reshapes the entire investment landscape, the kind of move that creates fortunes for those who are prepared and devastates those who are not. I have seen this happen before. I have lived through multiple interest rate cycles over my 70-plus years of investing. I remember when rates were at double digits in the early 1980s. I remember when Alan Greenspan slashed rates after the dot-com crash. I remember when Ben Bernanke took rates to zero during the financial crisis. And I remember what happened to different asset classes during each of these periods. The patterns are remarkably consistent when interest rates fall dramatically. One type of investment consistently outperforms everything else. Not gold, not bonds, not real estate, not even the broad stock market. There is one specific type of investment that benefits more than any other from falling rates. And if you understand why, you can position yourself to profit enormously from the next rate collapse. Let me take you back to a moment that shaped my understanding of interest rates and investing forever. It was 1981. Paul Volcker, the Federal Reserve Chairman, had raised interest rates to nearly 20% to crush inflation. The economy was in recession, unemployment was soaring, and everyone thought the world was ending. I was sitting in my office in Omaha looking at the stock market, and I saw something that most people miss. Stock prices had collapsed. The Dow Jones Industrial Average was trading at levels that seemed impossibly cheap. Companies with strong balance sheets, durable competitive advantages, and growing earnings were being given away for pennies on the dollar. But here is what really caught my attention. The best companies, the ones with the strongest competitive positions, were being punished the most by high interest rates. Their stock prices had fallen more than average companies, not because their businesses were weak, but because the high interest rates made their future earnings worth less in today's dollars. I realized something profound in that moment. When interest rates are high, the market discounts the future heavily. $1 of earnings 10 years from now is worth very little today because you could earn so much interest on your money in the meantime. But when interest rates fall, that calculus reverses. Suddenly, those future earnings become much more valuable. The discount rate falls, and the present value of future cash flows rises dramatically. This insight led me to load up on stocks in the early 1980s. I bought Washington Post Company. I bought Geico. I bought other wonderful businesses at prices that seem absurd in hindsight. And as interest rates fell over the following decades, from 20% down to the low single digits, those investments compounded at extraordinary rates. The same pattern repeated after the 2000 recession, after the 2008 financial crisis, and during other periods of falling rates. Each time, the investors who understood the relationship between interest rates and stock valuations made fortunes. Now here's why I believe interest rates could crash in 2020. Sixth, the Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. They took the federal funds rate from near zero to over 5% in less than 2 years. This was one of the fastest rate hiking cycles in history. But aggressive rate hikes always have consequences. They slow the economy, they stress the banking system, they cause asset prices to fall, and eventually something breaks. When something breaks, the Fed has to reverse course. They have to cut rates to prevent a recession or a financial crisis. I do not know exactly when this will happen. Maybe the economy slows more than expected. Maybe unemployment rises. Maybe there is a geopolitical shock or a financial accident that forces the Fed's hand. But I have seen enough cycles to know that rates do not stay elevated forever. The higher they go, the harder they eventually fall. And when rates fall, they often fall faster and further than anyone expects. The Fed tends to be reactive, not proactive. They wait too long to cut, and then they cut aggressively to catch up. We saw this in 2001, we saw it in 2008, and I believe we will see it again. So what is the one investment I would make if interest rates crash in 2020? 6 high-quality growth stocks with durable competitive advantages. I know what you are thinking. That sounds like the same thing I always talk about. Wonderful businesses at fair prices, competitive moats, long-term holding periods. And yes, these principles never change, but the application of these principles changes dramatically based on the interest rate environment. Let me explain why high-quality growth stocks benefit more than any other asset class from falling interest rates. When you buy a stock, you are buying a claim on all the future cash flows that company will generate. Those cash flows might come over the next 5, 10, 20, or 50 years. To value those future cash flows today, you have to discount them back to the present. The discount rate you use is heavily influenced by interest rates. Here is the mathematics that most investors do not understand. A company that is expected to generate most of its value far in the future is much more sensitive to changes in interest rates than a company generating most of its value today. Think about 2 companies. Company earns $100 million this year and will earn the same amount for the next 10 years. Company B earns $20 million this year but is growing at 20% annually and will earn over $100 million in 10 years. When interest rates are high, company A looks more attractive. You are getting the earnings now, not waiting for them. The high discount rate punishes company B's future earnings heavily. But when interest rates fall, company B's valuation explodes higher. Those future earnings that were being heavily discounted suddenly become much more valuable. The present value of company B's cash flows increases dramatically. This is not theory. This is exactly what happened from 2009 to 2020, one when rates were near zero. Growth stocks dramatically outperformed value stocks. Companies like Apple, Amazon, Google, and Microsoft saw their stock prices rise by thousands of percent, not just because their businesses grew, but because falling interest rates made their future growth worth more and more in today's dollars. And this is exactly what will happen again if rates crash in 2026. The high-quality growth stocks that have been punished during the rate hiking cycle will stage a massive comeback. Their future earnings will suddenly be worth much more as the discount rate falls. Now, I need to be very specific about what I mean by high-quality growth stocks, because not all growth stocks will benefit equally from falling rates. Some will thrive, others will collapse. The growth stocks I am talking about have 3 essential characteristics. First, they have genuine competitive advantages. They have something that protects them from competition. A powerful brand, a network effect, switching costs, cost advantages, something that allows them to maintain high profit margins even as they grow. Second, they are already profitable or close to it. They generate real earnings, not just revenue growth. They have proven business models that convert growth into cash flow. Third, they are growing because they are gaining market share, expanding into new markets, or benefiting from secular trends. Their growth is sustainable, not a one-time spike from a pandemic or a fad. These characteristics matter because not all growth stocks survive rate cycles. The speculative growth stocks, the ones with no profits, no competitive advantages, no sustainable business models. They get destroyed when rates rise, and they do not recover when rates fall. They simply go bankrupt because they cannot raise capital at affordable rates. But the high-quality growth stocks, the ones with strong balance sheets and real earnings, they survive the rate hiking cycle. Their stock prices might fall, but their businesses keep compounding. And when rates eventually fall, their stock prices recover, and then some. Let me give you some specific examples of what I am talking about. Apple is perhaps the finest example of a high-quality growth stock. They have the most valuable brand in the world. They have an ecosystem of products and services that creates enormous switching costs. They have over 1 billion active users who pay monthly subscription fees for iCloud, Apple Music, Apple Television Plus, and other services. When interest rates rose in 2022 and 2023, Apple's stock price fell. It went from over $180 to around $125, a decline of over 30%. Many investors panicked. They thought Apple was done growing. They thought the best days were behind it. But what actually happened? Apple kept generating enormous profits. They kept buying back stock. They kept paying dividends. They kept innovating with new products and services. The business was never impaired. Only the stock price was impaired. And when interest rates eventually fall, Apple's stock price will likely reach new highs. Not because the business suddenly got better, but because the lower discount rate makes those future cash flows worth more today. The same logic applies to other high-quality technology companies. Microsoft, with its dominant position in enterprise software and cloud computing, Google with its monopoly on internet search and its growing cloud business, Amazon with its dominance in e-commerce and cloud infrastructure. These companies have competitive advantages that will persist for decades. They are growing because the digital transformation of the economy is still in its early stages, and they are generating enormous free cash flow that will compound for shareholders over time. When rates fall, these stocks will lead the market higher. They will benefit more than average companies from the reduced discount rate, and investors who own them will see their portfolios appreciate significantly. But here's what most people get wrong. They wait too long to buy. They wait until rates have already fallen and stocks have already rallied. By then, the easy money has been made, the time to buy high. Quality growth stocks is before rates fall, when fear is high, when valuations have compressed, when everyone is talking about how rates will stay higher for longer. That is when you get the best prices. That is when you position yourself for the windfall that comes when rates eventually decline. I have made this same point many times throughout my career. Be fearful when others are greedy and greedy when others are fearful. Right now, many investors are fearful about high-quality growth stocks. They have been burned by the 2022 decline. They are worried about competition, regulation, and slowing growth. They are sitting on the sidelines waiting for clarity. But waiting for clarity means waiting until everyone else has figured it out too. By then, the stocks have already rallied and the opportunity is gone. Let me address the obvious question. What if rates do not fall? What if inflation stays elevated and the Fed keeps rates high for years? This is a valid concern, and I have thought about it carefully. But here is my response. Even if rates stay elevated, high, quality growth stocks will still be good investments over the long term. Their businesses will keep compounding. Their competitive advantages will keep generating profits. Their stock prices will eventually reflect their intrinsic value. Owning wonderful businesses at reasonable prices works regardless of what interest rates do. The rate environment affects the pace of returns, not the direction. If rates stay high, returns might be 10% per year instead of 15%. Still excellent, still far better than cash or bonds. But if rates crash, the returns could be 30, 40, even 50% in a single year. The upside from falling rates is enormous because of the mathematical relationship I explained earlier. Long duration assets like growth stocks are incredibly sensitive to changes in the discount rate. This asymmetric payoff is why I would make this my only investment if rates crash in 2026. The downside is limited to reasonable returns if rates stay high. The upside is explosive returns if rates fall. That is the kind of bet I like to make. Now let me talk about what I would not invest in if rates crash. I would not invest in bonds. This might seem counterintuitive. Everyone knows that bond prices rise when interest rates fall. And yes, you could make money buying long-term bonds before a rate decline, but the returns pale in comparison to what you can earn in high-quality growth stocks. Here's why. When you buy a bond, you know exactly what you're going to get. If you buy a 30-year Treasury bond, you will receive the coupon payment every year and your principal back at maturity. The price might rise if rates fall, but your total return is capped by the mathematics of fixed income. When you buy a high-quality growth stock, there is no cap on your returns. If the business keeps growing, keeps compounding, keeps expanding its competitive advantages, the stock price can rise indefinitely. The combination of business growth, plus multiple expansion from falling rates can generate returns that bonds cannot match. I would also not invest in gold. Gold is a popular asset when people are worried about monetary policy. They think gold will protect them from inflation or from central bank mistakes, and maybe it does over very long time periods, but gold does not generate any cash flow. It just sits there. You are betting purely on price appreciation based on other people's perception of value. That is speculation, not investing. When rates fall, gold might rise, but it will not compound like a great business. It will not pay you dividends. It will not buy back shares. It will not innovate and grow. It will just sit there hoping someone else will pay more for it in the future. I would not invest in cryptocurrency either. I know this will disappoint some people who believe that digital currencies are the future of money. Maybe they are. I honestly do not know, but I do know that I cannot value something that produces no cash flow, has no intrinsic utility, and depends entirely on what someone else will pay for it tomorrow. When rates fall, money flows into risk assets. Cryptocurrency might benefit from that flow, but it is not an investment in the traditional sense. It is a speculation on future demand, and I have never been good at speculation. I would not invest in speculative growth stocks either. The companies with no profits, no competitive advantages, no proven business models. These are the stocks that got crushed in 2022 and have not recovered. Many of them never will. When rates fell to zero during the pandemic, these speculative stocks went crazy. Companies with no path to profitability were valued at tens of billions of dollars. Investors justified absurd valuations by arguing that low rates made future profits worth more. But when rates rose, the music stopped. These companies could no longer raise cheap capital. Their cash runways shortened. Many went bankrupt. Others saw their stock prices fall 90% or more. When rates fall again, there will be another speculative frenzy. New investors will pile into unprofitable companies with exciting stories, and eventually those investors will get burned again. It is the same cycle that repeats throughout market history. I would not invest in real estate, at least not directly. Yes, lower rates reduce borrowing costs and can boost property values, but real estate is capital intensive and illiquid. You cannot easily adjust your position based on changing conditions. And the returns, while decent, cannot match what you can earn in the best growth stocks. There is also the ongoing disruption in commercial real estate. Office buildings facing work from home headwinds, retail properties competing with e-commerce, even residential real estate faces challenges from high prices and changing demographics. Real estate can be a good investment, but it is not where I would put my money if rates crash. So to summarize, if interest rates crash in 2020, 6, I would invest every dollar in high-quality growth stocks with durable competitive advantages. Companies like Apple, Microsoft, Google, Amazon, and a handful of others that combine growth with profitability and competitive moats. I would not invest in bonds, gold, cryptocurrency, speculative growth stocks, or real estate. These assets might perform okay if rates fall, but they cannot match the explosive returns that high-quality growth stocks can generate when the discount rate declines. Now let me address how you should implement this strategy practically first. You need to identify which growth stocks qualify as high quality. Not every company that is growing deserves your investment. You need to look for sustainable competitive advantages, proven profitability, and reasonable valuations. Ask yourself these questions about any growth stock you are considering. Can a competitor easily replicate what this company does? If the answer is yes, the competitive advantage is weak. Does this company generate real profits and free cash flow? If the answer is no, the business model is unproven. Is the valuation reasonable relative to the growth rate? If the price to earnings ratio is 100 times and growth is 10%, you are probably paying too much. Second, you need to be willing to hold through volatility. Stock prices fluctuate. Even the best companies see their share prices decline 20 or 30% during corrections. If you panic and sell during these declines, you will miss the recovery. The investors who profit from falling interest rates are the ones who buy quality stocks and hold them patiently. They do not try to time the bottom. They do not sell when prices fall. They understand that short-term volatility is the price of admission for long-term wealth creation. Third, you need to think in terms of decades, not quarters. The mathematics of compounding require time to work their magic. If you buy a great company today and hold it for 20 years, the returns will likely be extraordinary regardless of what interest rates do in any single year. But if you are constantly trading, constantly worrying about short-term price movements, constantly reacting to news headlines, you will underperform. You will sell good investments too early. You will buy bad investments because they are popular. You will rack up taxes and commissions that eat into your returns. Fourth, you should consider dollar cost averaging into your positions. If you have a large sum to invest, you might spread your purchases over several months. This reduces the risk of buying everything at a short-term peak. And it gives you psychological comfort knowing that you have more purchases ahead at potentially lower prices. Fifth, you should keep some cash available for opportunities. When rates do eventually fall, there will likely be volatility. There might be a financial accident or an economic slowdown that causes stock prices to decline before they recover. Having cash available allows you to buy more shares at lower prices. I always keep some cash at Berkshire Hathaway, not because I am bearish, but because I want to be ready when opportunities appear. The best buying opportunities come during crises, and you can only take advantage of crises if you have capital available. Let me share one more historical example that illustrates the power of buying quality growth stocks before rates fall. In early 2009, the world was falling apart. The financial crisis had devastated stock prices. Banks were failing. Unemployment was skyrocketing. Everyone thought the economy might collapse entirely. Interest rates had already fallen to near zero, but stocks had not responded yet. Investors were too afraid to buy. They thought the world was ending. They wanted nothing to do with equities. I made several large investments during that period. I invested in Goldman Sachs. I invested in General Electric. I invested in other companies that were fundamentally sound, but whose stock prices had collapsed due to fear. Over the following years, as the economy recovered and interest rates stayed low, these investments performed extraordinarily well. The stock prices recovered, the dividends flowed, the mathematics of compounding worked in my favor. The same opportunity will present itself again maybe in 2026, maybe a year later or a year earlier. But the cycle will repeat because it always does. Interest rates rise, fear increases, stock prices fall. Then interest rates fall, confidence returns, stock prices rise. The question is whether you will be positioned to benefit, whether you will have the courage to buy when others are fearful, whether you will own the high-quality growth stocks that benefit most from declining rates. I cannot tell you exactly when rates will fall. I cannot tell you exactly which stocks will perform best. But I can tell you that the pattern is consistent and predictable. And I can tell you that the investors who understand this pattern and position themselves accordingly will build substantial wealth over time. The investment environment is always changing. Interest rates rise and fall. Economies expand and contract. Sentiment swings from euphoria to despair and back again. But through all of this change, certain principles remain constant. Good businesses compound over time. Competitive advantages create durable value. Patient investors outperform active traders, and long-duration assets like quality growth stocks benefit enormously from falling interest rates. If you remember nothing else from what I have shared today, remember this: when interest rates crash, the time to act is before it happens, not after. The investors who wait until rates have fallen and stocks have rallied will kick themselves for missing the opportunity. The investors who buy quality growth stocks today, while fear is elevated and valuations are reasonable, will be rewarded when rates eventually decline. This is not speculation. This is not market timing. This is understanding the fundamental mathematics of how asset prices respond to changes in interest rates and positioning yourself accordingly. I've been doing this for over 70 years. The specific opportunities change, but the underlying logic never does. When others are fearful, be greedy. When rates are high and expected to fall, buy long-duration assets. When quality companies are trading at reasonable valuations, accumulate shares. That is what I would do if interest rates crash in 2026. That is what I have always done, and that is what I will continue to do for as long as I am investing. The opportunity is in front of you. The mathematics are clear. The historical precedents are overwhelming. The only question is whether you have the discipline and patience to act on this knowledge. I believe you do. And I believe that those who act on these principles will look back years from now, recognize this period as one of the best opportunities of their investing lives. That is the power of understanding how interest rates affect asset prices. That is the power of owning wonderful businesses at reasonable prices. And that is why high-quality growth stocks are the only investment I would make if interest rates crash in 2026. The rest is just noise. Tune it out, focus on the fundamentals. Buy quality, hold patiently, and let the mathematics of compounding work in your favor. That is how fortunes are built. That is how wealth compounds over generations. And that is the approach that has served me well for over 7 decades in this business. Let me go deeper on why this particular moment in history is so significant for investors who understand the interest rate cycle. We are at an inflection point. The Federal Reserve has done something it has not done in 40 years. They raised rates at a pace that shocked financial markets. They did it to fight inflation that reached levels not seen since the early 1980s. And they have stated repeatedly that they will keep rates higher for longer until inflation is fully under control. But here is what the Fed never tells you. They are always fighting the last war. They respond to conditions that have already happened, not conditions that are developing by the time they realize the economy is slowing, unemployment is rising, or financial stress is building. They have already kept rates too high for too long. This is not a criticism. It is simply how monetary policy works. The Fed has imperfect information and long policy lags. Their decisions today do not fully affect the economy for 12 to 18 months. So they are always operating with outdated data and delayed effects. The result is that rate cycles overshoot in both directions. Rates go higher than necessary during inflation scares. Rates go lower than necessary during recessions. And the transitions between high rates and low rates are often abrupt and surprising. Investors who understand this pattern can position themselves ahead of the crowd. They can buy assets that will benefit from the next phase of the cycle before everyone else figures it out right. Now, the crowd believes that rates will stay higher for longer. They believe the Fed is serious about fighting inflation. They believe that the era of cheap money is over permanently. And because they believe these things, they have sold their high-quality growth stocks and moved into cash or short-term bonds. But crowds are usually wrong at turning points. The consensus view is always most confident right before it is proven wrong. When everyone believes rates will stay high forever, that is often when rates are about to fall. I am not saying I know exactly when this will happen. Predictions about timing are dangerous and usually wrong. What I am saying is that the setup is in place for a significant rate decline. The economy has absorbed a lot of tightening. Consumer spending is showing signs of fatigue. Corporate profits are under pressure. Banks are tightening lending standards. All of these factors point towards slower growth ahead, and slower growth eventually leads to lower interest rates. It might happen in 2026. It might happen sooner or later, but it will happen because it always does. Let me also address the question of how much you should allocate to this strategy. I am not suggesting you put 100% of your net worth into growth stocks tomorrow. That would be reckless for most investors. You need to consider your personal circumstances, your time horizon, your ability to tolerate volatility, and your other financial obligations. For younger investors with decades ahead of them, a heavy allocation to high-quality growth stocks makes sense. They have time to ride out volatility. They can keep adding to their positions during their working years, and the compounding over 30 or 40 years will be extraordinary. For older investors approaching or in retirement, the calculus is different. They need income now. They cannot afford to see their portfolios decline 50% and wait years for a recovery. For them, a more balanced approach makes sense, with growth stocks as a portion of the portfolio alongside dividend stocks, bonds, and other assets. But regardless of age, I believe every investor should have some exposure to high-quality growth stocks. These are the companies that are shaping the future of the economy. These are the businesses that will grow for decades, regardless of what interest rates do. And these are the investments that will benefit most if rates crash. The specific allocation depends on your situation. Maybe it is 50% of your portfolio, maybe it is 30%, maybe it is 20%. But it should not be zero. The opportunity is too compelling to ignore entirely. Let me also talk about the psychological challenges of this approach. Buying growth stocks when everyone else is selling requires courage. It requires conviction in your analysis. It requires the ability to tune out the noise and focus on fundamentals. Most people cannot do this. They follow the crowd. They buy when stocks are high and sell when stocks are low. They repeat this pattern throughout their lives and wonder why they never build wealth. The investors who succeed are the ones who think independently. They do their own analysis, they form their own conclusions, and they have the courage to act on those conclusions even when the crowd disagrees. This is not easy when stock prices are falling and the news is terrible and everyone you know is panicking. Every instinct tells you to sell. Your brain is wired to seek safety. Selling feels like the safe thing to do. But selling during a panic is almost never the right decision. The time to be cautious is when everyone is euphoric, not when everyone is terrified. By the time fear reaches extreme levels, most of the damage has already been done. The future is usually brighter than the present feels. I have trained myself over decades to see market declines as opportunities rather than threats. When stock prices fall, I do not feel fear. I feel excitement because I know that falling prices mean I can buy more shares of wonderful businesses at better prices. This mindset does not come naturally. It has to be cultivated through practice and discipline. But once you develop it, you have an enormous advantage over other investors who are slaves to their emotions. Let me share another lesson from history that reinforces this point. In 1974, the stock market was in free fall. The oil crisis, Watergate, and recession had combined to create one of the worst bear markets since the Great Depression. Stocks had fallen over 40%. Investors were fleeing the market in droves. I was buying everything I could get my hands on. I wrote in a Forbes interview that I felt like an oversexed guy in a harem. That was how excited I was by the opportunities available. Was I scared? Of course, the news was terrible. The economy was struggling. Nobody knew when the decline would end, but I also knew that I was buying wonderful businesses at prices that made no sense. Companies trading at 5 or 6 times earnings, companies with strong balance sheets and market-leading positions, companies that would thrive once the crisis passed. And they did thrive. The stock market recovered. The economy expanded, and the investments I made during that dark period generated returns that compounded for decades. The same pattern will repeat itself in the future. There will be another crisis, another panic, another period when investors are selling quality stocks at irrational prices. And the investors who have the courage to buy during those periods will be rewarded enormously. This brings me to my final point. The most important investment you can make is in your own knowledge and temperament. Understanding why high-quality growth stocks benefit from falling interest rates is valuable, but it is not enough. You also need the emotional discipline to act on that understanding when the time comes. You need to control your fear when markets are falling. You need to control your greed when markets are rising. You need to think long-term when everyone around you is focused on the short term. These skills cannot be learned from a book or a video. They have to be developed through experience, through making mistakes and learning from them, through living through market cycles, and observing how different approaches perform. I have been fortunate to have over 70 years to develop these skills, but you do not need 70 years. You can accelerate your learning by studying history, by analyzing your own behavior, by being honest about your mistakes. Every mistake is a lesson if you are willing to learn from it. Every market cycle teaches you something new about yourself and about investing. The investors who treat these experiences as education rather than trauma are the ones who ultimately succeed. So yes, I believe high-quality growth stocks are the best investment if interest rates crash in 2020. 6, the mathematics are compelling. The historical precedents are clear. The opportunity is significant. But more than that, I believe that developing the knowledge and discipline to act on opportunities like this is the real key to building wealth. The specific investments matter less than the process. The individual stocks matter less than the principles. Learn the principles, practice the discipline, develop the temperament, and when the next great opportunity presents itself, whether it is falling interest rates or something else, you will be ready to act. That is the path to building lasting wealth. That is how fortunes are made over lifetimes. And that is the approach that I believe will serve you well regardless of what the future holds. Now it is your turn to apply these lessons. The opportunity is there. The principles are clear. All that remains is the courage to act.